rapid evolution of blockchain-based financial systems has brought two interconnected trends to the forefront: the rise of stablecoins and the tokenization of real-world assets (RWA). Together, they are shaping the next phase of digital finance, offering new forms of liquidity, transparency, and financial inclusivity. As research from arXiv and other academic sources highlights, these innovations are no longer experimental. They are becoming the backbone of the emerging global financial infrastructure. Stablecoins, by design, serve as a bridge between traditional finance and the crypto ecosystem. They are digital tokens pegged to stable assets such as fiat currencies, like the US dollar, commodities, or even algorithmic reserves. Unlike volatile cryptocurrencies, stablecoins maintain consistent value, making them ideal for payments, settlements, and DeFi operations. Their stability has positioned them as a crucial foundation for blockchain-based finance, facilitating everything from cross-border remittances to collateral in decentralized lending platforms. However, the growing influence of stablecoins introduces new layers of complexity in financial stability and regulation. The design choices behind stablecoins, including their custody models, collateralization mechanisms, and governance structures, significantly influence their resilience and systemic risk. For instance, fiat collateralized stablecoins like USDT or USDC rely on centralized entities that hold real-world reserves in banks or financial institutions. While these models provide simplicity and regulatory clarity, they reintroduce counterparty risk and dependence on traditional custodians, contradicting the decentralized ethos of blockchain. In contrast, algorithmic or crypto-collateralized stablecoins, such as DAI, operate through smart contracts without a central custodian. Their stability depends on over-collateralization and dynamic market mechanisms, which can make them more transparent but also vulnerable to liquidity crises during sharp market downturns. The collapse of algorithmic stablecoins like Terra USD in 2022 underscored the systemic risks inherent in such models. These events have intensified research interest in designing more robust, transparent, and governable stablecoin frameworks that can withstand market shocks while maintaining decentralization. Governance also plays a pivotal role in determining the safety and scalability of stablecoins. Decisions regarding reserve management, auditing, and collateral composition can directly impact market confidence. Decentralized governance models, such as those based on DAOs, decentralized autonomous organizations, aim to democratize these decisions, but face challenges related to coordination, accountability, and regulatory compliance. Striking a balance between decentralized governance and regulatory oversight remains a critical research and policy frontier. Parallel to the rise of stablecoins is the growing movement toward tokenization of real-world assets, RWA. The process of representing tangible or traditional financial assets, such as real estate, bonds, equities, or commodities, as digital tokens on blockchain networks. Tokenization transforms these assets into programmable, tradable units that can move seamlessly across digital financial systems. By enabling fractional ownership, tokenization democratizes access to traditionally illiquid markets, allowing investors to participate in high-value assets with minimal capital. This tokenized representation of assets has profound implications for liquidity and regulation. On one hand, it enhances liquidity by allowing 24/7 trading and instant settlement of assets that were once restricted by geography, time zones, or market intermediaries. For example, tokenized treasury bills or corporate bonds can be traded peer-to-peer without relying on clearinghouses, reducing settlement risk and transaction costs. On the other hand, such fluidity challenges traditional regulatory frameworks that were designed for slower, intermediated markets. Questions of asset custody, investor protection, and jurisdictional oversight become more complex in a borderless, tokenized environment. Furthermore, RWA tokenization could reshape global capital markets by blurring the lines between traditional finance, TradFi, and decentralized finance, DeFi. It has the potential to integrate on-chain liquidity pools with off-chain assets, enabling investors to seamlessly allocate capital between fiat and digital instruments. Yet, This convergence also heightens the need for regulatory coordination, especially concerning anti-money laundering, know your customer (KYC), and compliance standards. Research in this domain, as documented in recent arXiv studies, is now focusing on systemic risk modeling for stablecoins and regulatory frameworks for RWA tokenization. Scholars are analyzing how different stablecoin architectures respond to stress scenarios and how tokenization affects market efficiency, capital formation, and financial stability. One key insight is that the stability of the broader digital economy may increasingly depend on the robustness of these token-based infrastructures. In conclusion, stablecoins and the tokenization of real-world assets are redefining the contours of modern finance. Stablecoins are emerging as the transactional backbone of digital economies, while tokenization is unlocking new avenues of liquidity and access. Yet, their long-term success will depend on how effectively they balance innovation with governance, transparency, and systemic safety. As these technologies mature, they are poised to form the structural pillars of a new, programmable, and globally interconnected financial infrastructure, one where the boundary between traditional and digital finance becomes virtually invisible.